Thank you very much, everybody. For those of you that were at the conference earlier today, I will be giving a similar presentation that I gave this morning, so I apologize in advance. But we're going to allow lots of time for questions at the end, and I would encourage you to take advantage of that. So look, I'm the Chief Market Strategist of the World Gold Council. I've been in this industry for 40 years as a mining engineer, as a commodity strategist, as a gold equity analyst, as a hedge fund manager, and for the last 8 years, I've been at the World Gold Council. We are uniquely placed, set up by the mining industry, funded by the mining industry, and now funded by the gold ETF. We're a non-for-profit that makes a ridiculous amount of money from gold. So we invest that money back into developing the gold market, to telling the story about gold. We try and grow gold demand, both investment demand, central bank demand, and jewelry demand. And I spend my time traveling around the world talking about gold. So I describe myself as the most boring dinner party guest you will ever have, because I know an enormous amount about a very small part of the world, which is gold. So I genuinely ask at the end, please ask me anything about gold. I was here last year, same time roughly. Gold had just broken out. Okay, we're up something like, I don't know, 40% since then, trading at $3,000 an ounce. This chart actually is out of date by about a week, so of course it's about $100 out of date as well. It truly has been a remarkable performance, but even more so when you look over the last 30 years. I remember gold trading at $252 an ounce back in 2001, sitting on the trading desk of UBS, when most of our job was persuading gold mining companies to hedge and sell forward. Investors didn't care. Roll forward now and look where we're at. We're at $3,110 an ounce, and it's been a remarkable ride. I'll try and explain some of the reasons why it's been such a remarkable ride, why gold delivered 26% returns in 2024, the best performing asset class out there, beating even super strong US equities. And again, this year, I'm afraid again, out of date by a few days, it's even better than this, still the best performing major asset class. Gold is up 19% in US dollar terms in the first quarter. We've hit 20 all-time highs in gold in the first quarter. Last year, we only hit 40 all-time highs. So this year has started pretty well. One of the things we do at the World Gold Council is we produce a tremendous amount of research and data about the gold market. Our biggest publication is what we call Gold Demand Trends. It comes out each quarter. And of course, we're just one day now into the new quarter, so we don't have those figures yet. We'll be getting them internally over the next week or two, and then we'll produce this report at the end of the month. So I'm going to talk a little bit about what happened last year in gold, what were the drivers of the strength in gold, and then we'll talk about what's been going on since then. Gold demand hit a record level last year in tonnage terms. There was strong performance from certain sectors of demand in the market, particularly central banks, which bought about 20% of gold demand for the third year in a row. We saw strong investment demand coming through as well, as exchange-traded fund investors returned to the buy side in gold in the second half of the year. We saw weak jewelry demand, which you'd expect because the price had gone up so much. On the supply side, we saw record mine production. But as I'll demonstrate, gold mining companies haven't been able to take advantage of the record prices that we've seen in the last couple of years. And I'd argue they probably won't be able to grow production much further from here in aggregate. In terms of jewelry demand, that's jewelry demand by quarter. And you can see the dips that took place, particularly in the second quarter of the year as the gold price started to zoom higher. But look at the gold line there as well. That's the amount of dollar billions that jewelry buyers have spent on gold. Yes, demand was down about 11% in the jewelry sector, but the amount of money they spent on it, with gold prices up 26% over the year, was still up strongly. And that's a really positive signal. Jewelry demand's never going to be strong when the gold price has been motoring like it has. But the fact that, if you look at that chart, the jewelry market's still a big, important component of the market. This is what will help us when we do get a correction. If you look at the various countries and regions, we saw jewelry demand down everywhere, but particularly in China, down something like 24% over the year. The Chinese economy is weak. Real estate, which is where most people in China store their wealth, has been falling precipitously. And to be frank, still looks really expensive. So gold is getting bought by investors, but it's not getting bought by jewelry customers. Sentiment is weak in China. Marriages were down 10% year on year in China. People aren't even confident enough to get married. As a divorced person, that could be a good idea, but anyway. But overall, we saw jewelry demand weak. Fair enough. Probably the biggest component, though, of investment demand for gold comes from physical buyers of coins and small bars. And if you look at this chart, the last 4 years, it looks pretty boring. It's been pretty steady, strong, but not growing. But there's some big changes within these numbers that I want to highlight. Because for all the enthusiasm that we've heard in the room today about gold, for all the enthusiasm that I've heard at the Denver Gold Conference in the Park Hyatt, European investors are not buying physical gold. Germany turned a net seller at one point last year, and that's one of the biggest buyers of physical gold in the world. The United States is down about 50% compared to where it was a couple of years ago. This has not been a story of developed market strength. What's been driving gold demand in the last 2 or 3 years has been emerging market buying of gold. That's turning up here in really strong Indian investment demand in gold, and even stronger Chinese investment demand for gold. I'll come back to that in a moment. Because when you look at exchange-traded funds, it's the same thing. Who owns exchange-traded funds of gold? Western investors predominantly. It's a European and it's a North American phenomena. And they've sold gold every year for the last 4 years. Not huge quantities, but they've sold gold for the last 4 years. They turned positive in the second half of last year. And that's because Western investors, via ETFs at least, have started to return to the market. But there's something else you can see here as well. Look at the purple bars there. Horrible colors, sorry. Branding that we have at the World Gold Council is dreadful. The colors are awful. But you can see those pink bars up there. That represents emerging market ETF demand. China and Indian buyers of gold via exchange-traded funds and via bars and coins. So they've been buying gold, and only recently have we started to see Western investors turn the corner. Central banks, this is an emerging market story. Central banks, Western central banks, sold gold for 21 years in a row up until the global financial crisis. Since the global financial crisis, they've bought every year. And that buying has been emerging market central banks. And they dramatically increased their purchases in 2022, doubling it to over 1,000 tons. And that 1,000 tons continued in 2023 and 2024. Why? Well, inflation's probably going to be more of a problem going forward than it has been in the past. Fine. There's a slow de-dollarization going on from central banks as they reduce their holdings in the US dollar, and gold's benefiting from that. But the main reason was because of the sanctions that were placed upon the Central Bank of Russia following the invasion of Ukraine. Central banks now realize that assets they hold in Western financial systems are vulnerable to political decisions to take those assets away from them. If you own gold and you hold it in your own country, that remains your asset. Now, some people ask me, what happens if peace breaks out? What happens if the US imposes a peace deal upon the Ukraine and takes away sanctions on Russia? Does that mean this buying goes away? I don't think so. The genie is out of the bottle here. The Western powers have shown their hand that they are prepared to take reserve assets away from central banks if those central banks don't do what the United States and what other Western countries want them to do. And if you think about the pronouncements that have come out of the United States in the last few months, I think there's a lot of countries out there that thought they were allies of the United States that are beginning to now wonder whether they are or not. So the extent to which central banks are buying gold is going to continue, and I suspect we might see a few more central banks buying gold. If you look at the list of who bought last year, all emerging markets. Poland, China, India, Turkey, the top four. I'm not going to list them all because I can't see them because the writing is too small. That's the good thing. There are so many central banks, I can't read the bloody slide. There were a few sellers as well. There always are. Those sellers are primarily central banks who buy gold from domestic producers. They have a lot of gold. When the price is high, they choose to sell some. We always see them. I'm not worried about that. Probably the more interesting graph is this one, though, and it probably takes a bit of explaining. So we report central bank changes in central bank reserves in two ways. Central banks are supposed to report their gold holdings to the IMF every month, along with their foreign currency reserves. Most central banks do this. They tell the truth, they report it, that's fine. Some central banks don't quite get that right. So sometimes they're a bit late in their reporting, sometimes they're not reporting all of their purchases, and that's always been a factor. But from 2022, these green bars, which represent the difference between what's being reported and what we estimate, along with our partners, is taking place, have got huge. Why is that? Emerging market central banks are buying a lot more gold than they are telling the IMF. And they're buying a lot more gold because they don't want to tell the world how much gold they're buying. Now, we don't speculate about who these unreported purchasers are, but it's China. Don't quote me, journalists in the room. Sylvia, you didn't hear that. But it's China for about 80% of these numbers. And we're pretty confident about this. And the reason I say this, we get the data from Metals Focus, fine. When we got the first number that came through, that big green bar that came through in the second quarter of 2022, we said, hang on, what the hell is going on here? We stopped the production of our reports, we interrogated them, and we spoke to people in the gold market. Some of us have got good contacts in the gold market, and confirmed that there's a lot more buying going on than is being reported. And that buying continues. And what I say to people is, look, it's an estimate. We don't know for sure. But if we're wrong, we're probably too low. There is an enormous amount of central bank buying going on out there. There's probably some central banks and sovereign wealth funds that we're missing. Buying a lot of gold. Now, why is that? Developed market central banks have about 25% of their reserves in gold for legacy reasons. Emerging market central banks have much less, probably an average of about 10%. Emerging market central banks have trillions of dollars of foreign exchange reserves. They can keep buying for years, maybe decades to come. So this trend that we've seen over the last couple of years is likely to continue. And as I said, for reasons I discussed before, probably more central banks will be thinking about the dollar holdings that they have and wondering just how safe they might be. On the supply side, yes, we hit a new all-time high for gold production in 2024, just. The previous all-time high was in 2018. You can see, for example, the impact of COVID there as well. But this is an industry that has been unable, in aggregate, to grow. Gold mining companies, in total, have not been able to take advantage of these record prices by expanding production. That's good for somebody that likes gold and is worried about potentially seeing the market flooded with new supply because it's not coming. Now, there are some good things, and I heard somebody say before, Trump is good for the mining industry, and he probably is in the United States. We probably will see more permitting taking place in the United States. And that probably means a few more gold mines. But they're not going to come to the market now. They're not going to come to the market in 2 or 3 years' time. That's probably 5 or 10 years down the line, and that's one country. And at the same time, if you look at where gold production has become concentrated, which is Africa, and if you look at the instability which is taking place in certain parts of Africa at the moment, that's causing problems to production as well. So I'm not bothered about what Trump is doing to encourage mining in the United States, it will be probably offset by political difficulties elsewhere. But mine production is 3,600 tons, more or less. Recycling is about 1,400 tons. This is old jewelry owned around the world. And when prices go up, people sell it back. So recycling supply did increase last year. This is how high prices impact gold supply. But only up 11%. It'll be up again this year, I'm sure, but it's not swamping the market, not yet. Okay, so what are we expecting for this year? We put out our outlook for gold in December, and you're immediately wrong. And that's the problem with forecasting, is you always get it wrong. Having said that, I'm reasonably comfortable with most of what's on here. The first of which is investors. We're expecting more investment demand for gold this year, and that's coming through, and I'll show that in a few minutes. I'm expecting less jewelry demand because the price is high. Central banks, well, I have a huge problem with our central bank team. We have a team of 4 people whose job is to speak to central banks only. There's only about 190 of these central banks. We speak to them all. They're always conservative. They always say, when I ask them, how much central bank buying are we going to get this year? They say, oh, no, it won't be as much as last year. It never will be. And then, of course, it is. Because they're small c conservative people. They don't want to put themselves on a limb. I personally think we're going to see a lot more central bank buying over the next few years, and that might start to turn up this year already. On the supply side, yeah, we might get a bit more production. We might not. We will get more recycling. But overall, the gold market's in a reasonably decent shape in terms of supply and demand. When we looked at various price scenarios in that December outlook, we said to our investors, or we said to our readers, depending on the economic scenarios, you would probably see a positive outcome for gold this year, but it's not going to be that great. 26% returns in gold in 2024 is remarkable. You're not going to get that again. It's going to be much more like the long-term returns you can expect. But the problem is we focused upon economic developments when we wrote that outlook. What I don't think anybody has expected is for politics to be so important. Gold's traded much higher already than we had expected. And to be frank, I think there's more to come. So what's been happening recently? I think the first thing I'd say is this chart shows the ETF holdings on a monthly basis, and the blue is because I haven't got the final figures yet for March. But the trend of strong ETF buying that happened from about the middle of last year has continued this year. Provisional numbers are about 225 tons of buying of gold by ETF investors everywhere, Asia, Europe, North America. If you compare that to the beginning of 2024, I can already tell you that the headlines for gold demand trends are going to be massive increases in investment demand because we've got plus 225 tons versus minus 150 tons from ETFs. So that's really positive. In terms of investors and speculators, yeah, COMEX trading investors still own good amounts of gold. They don't own as much as they did a few months ago, and that, to be frank, is good as far as I'm concerned. Because what worries me when investors and speculators and short-term money is long gold, the next move is often profit-taking. But one of the characteristics of this rally we've seen in gold over the last 12 or 13 months is there's been very few corrections in the gold price. Each time the gold price comes under pressure from profit-taking from speculators, it gets bought. So corrections are shorter and shallower than grey-haired people like me would expect. And why is that? I think that's because central banks are standing beneath the market, mopping up any of the selling that's coming through from investors and speculators. Now, the other thing I want to touch upon, and it's been sort of alluded to in comments earlier, we've seen some remarkable flows in the gold market in the last few months. And I mean physical flows of gold that have gone from London to Switzerland and then into the United States. So this chart here shows you the level of physical gold held in inventories associated with the COMEX futures market in and around New York. This is an unprecedented level of stocks, and the rate of increase has been massive. So there's lots of headlines about gold flying to New York. Lots of headlines I hear around the table tonight about Swiss exports of gold. This is all to do with tariffs. This is not investment buying of gold. The tariff story in gold is quite an interesting one, really, because the US is a decent-sized gold producer, and it's a decent-sized gold consumer. And if you look at the production and consumption numbers for gold, it's about the same. So if you do slap tariffs if the United States slaps tariffs on the world, it probably doesn't affect gold demand in America that much. But as well as production and consumption, you've also got speculation and trading. The futures market in New York is massive. COMEX speculators, which is the graph I've shown here, are basically long gold all the time. So they've bought gold futures. They're hoping to profit from an increase in the price of gold. They're probably not going to take delivery because they very rarely do. That's fine. So who's the other side of that trade? The other side of that trade is banks. Banks are short COMEX futures, but they're not short gold overall. They're short COMEX, gold and silver, but they're long in London. Why are they long in London? It's cheaper to store it. You can use it. People in America don't take delivery of gold via futures, so you don't need to have it there. And if they do take delivery, it's no big deal. You ship it to a refinery in Switzerland, you turn it into 1 kilogram bars, you send it to the States, and you can satisfy that delivery obligation. And that's fine, and that works really well. But what about if suddenly tariffs are slapped upon US imports? And suddenly that gold, if you import it into the United States, costs you 10% more, 20% more, 25% more. So banks responded to that by moving enormous quantities of gold into the United States. Now, tomorrow is Liberation Day. I'm not quite sure what we're going to be free from, but rationality maybe. But tomorrow is Liberation Day. If you needed to get gold into the United States, you've done it already. And if you look at the level of gold that is there, to me, that's probably more than enough. So these shipments of gold will slow down. Only the banks that were a bit late are going to get their gold into there now. The other thing you might have, I'll skip that one. The other thing you might have heard about as well is shortages of gold in London. Well, no, not really. Shortages of gold available to the market in London, yes. Why? Because much of the gold that's held in London is held in the Bank of England. Now, Bank of England, the old lady of Threadneedle Street, government employees, when demand gets busy, do they suddenly increase their staffing levels by 300 or 400%? No, they don't. They work a bit of overtime, but then they go home at 6 o'clock rather than 4 o'clock. So there's a lot of gold stuck in the Bank of England's vaults that was in a queue, waiting to come out. And because that gold had gone to Switzerland and then New York, and people needed gold in London, suddenly the cost of borrowing gold went really high, and people started talking about shortages. Fine. There were short-term shortages of available gold in London, and borrowing costs got really high. Annualized cost to borrow gold got to 5-6%. That's now over. So the headlines you've been reading about shipments of gold from London to New York and the shortages of gold in London are probably over. I don't think this has contributed to the strength in the gold market, strength in the gold price. I don't think these shortages have been anything other than a great excuse for journalists to ask me the same bloody questions all the time for about 4 or 8 weeks. It's now over. But it is worth bearing in mind. It demonstrates gold as a physical asset. Yes, we trade gold on computer screens. We go long, we go short, we play all those games. Wonderful. But in the end, gold is a physical asset. We've seen unprecedented movements of gold out of London, eventually into New York, and the gold market's absolutely fine. Ask me a question about silver at the end, and I'll tell you why that's different. Okay, look, so I'm going to stop talking in 2 minutes, but I've got 2 slides I just want to finish up on. Where are we now? And where are we going? I think we have to recognize that gold produced a stunning performance last year. Work we've done in terms of long-term asset allocation studies shows you that gold should deliver roughly US inflation plus 2 to 3%. Last year we got 26%. Previous year, we actually got 19%. This year, we've got 19% year to date. These are unprecedented times in the gold market, and it shows you just how strange a place we're in. It's mostly been emerging market demand for gold. That's been the story of the last few years. Emerging market central banks, emerging market investors, from time to time, strong emerging market jewelry demand even, emerging market ETF demand. Western investors have bought much less gold and via ETFs actually sold gold than would normally be the case. Now, emerging market buyers are slowing down somewhat, so what I would argue, from here, if we are to sustain these prices above $3,000 an ounce, we need to see Western investors step up. They have done so already, perhaps, via exchange-traded funds. We've seen positive exchange-traded funds now for 9 months, 10 months, with the exception of November. But bar and coin demand, physical gold purchases, have still not recovered yet. And I'm really looking forward to getting the data we'll get in the next few weeks for the first quarter. What might make them buy more gold? Lower interest rates certainly are one issue. A recession in the United States becoming increasingly likely if you listen to the investment banks that forecast these things. Concerns about debts and deficits will become more common topics of conversation, not just in this room, but in the general room, as people start to worry about the sustainability of debt levels in the West. I argue that Trump's victory is gold positive. Not necessarily for good reasons, but because trust in the United States, certainty about policy, all of those things have weakened so far, and I expect those to remain weak. People who hold US dollar assets will become concerned. Whether you're equity investors worried about the potential for a slowdown or the impact of tariffs, whether you're central banks wondering whether you actually will ever be able to access your US dollars if you need them. Those are going to be a dominant theme. So gold is at or very close to an all-time high. The gold market was disturbed by these tariffs. But if you look at the combination of weak equities, a weak US dollar, and strong gold, all of that tells me this is politically driven. This is about concerns about the US economy. This is about concerns about the United States. And to be frank, I suspect we're going to get more of this to come. Thank you very much.